Have you ever wondered why the Nifty index is hitting record highs while the global market is in a slump? It's a question that's been making the rounds, especially given the record-breaking surge of India's benchmark Nifty index on February 22, 2024. While other markets are grappling with a downturn, the Nifty's defiance of this trend has sparked quite the conversation. So, let's break down this bullish move and explore the elements that are fueling it. Firstly, we have strong corporate performance. Power players like ICICI Bank, Airtel, and Mahindra have been posting impressive growth in earnings and stock prices. This has been a significant confidence booster for investors, underscoring the potential of the Indian market. Secondly, we can't overlook the role of foreign fund inflows. Despite the uncertainties clouding the global landscape, foreign institutional investors have continued to invest in Indian equities, drawn by the country's relatively stable economic fundamentals and appealing valuations. Then, there's the positive macroeconomic data. Recent figures indicate healthy GDP growth, controlled inflation, and an uptick in domestic demand. This has further stoked optimism about the Indian economy. And last, but not least, we have political stability. The recent state election results and the overall political environment have provided a sense of security to investors. This is particularly significant when compared to the volatile situations playing out on the international stage. So, what do we have here? We have robust corporate growth, continuous foreign fund inflows, positive macroeconomic indicators, and political stability. Each of these factors has played a key role in driving the Nifty's rise. These elements have created a conducive environment for the Nifty's bullish move, despite the global market's downturn. But as always, it's important to remember that financial markets are inherently volatile. Today's surge could be tomorrow's slump. Hence, maintaining a long-term perspective and diversifying investments remains crucial for navigating the ebbs and flows of the market. While the Nifty thrives, the global market is experiencing a slump. But why? Let's take a look at the bigger picture. The world economy is grappling with a few key issues. Firstly, there's the looming threat of rising interest rates. Central banks across the globe are tightening their monetary policies in an attempt to curb inflation. This has triggered a sell-off in global equities, causing markets to dip. Secondly, geopolitical tensions are at an all-time high. The ongoing war in Ukraine and escalating tensions between Russia and the West have cast a shadow of uncertainty, dampening investor sentiment globally. Finally, there are concerns about an economic slowdown. Fears of a recession in major economies are adding to the market jitters, making investors more cautious and less willing to take risks. These factors have led to a bearish global market, in stark contrast to the Nifty's performance. Given the global slump, how can the Nifty maintain such a bullish trend? Now, this is a question that has been puzzling many. The answer could lie in a few factors that set India apart from the rest of the world. Firstly, the Indian economy relies heavily on domestic demand with limited exposure to global trade. This means it's less susceptible to external shocks, unlike many other emerging markets. Secondly, the government's focus on domestic growth through initiatives and reforms aimed at boosting domestic consumption and infrastructure development offers long-term growth prospects for Indian companies. Lastly, the attractive valuations of Indian equities compared to developed markets are enticing value investors. However, it's worth noting that this resilience doesn't render the Nifty immune to volatility. Continued global uncertainties and domestic factors like rising interest rates and inflation could impact its future trajectory. While the Nifty's performance is encouraging, it's crucial to remember that markets are inherently volatile, and diversifying investments remains key to navigating market fluctuations.